After falling nearly 50% from their highs in 2025, Spotify finally got some good news today. Shares are up about 18% as I'm recording, and that's because the company reported a pretty strong fourth quarter 2025 results. It wasn't a lot of blowout numbers, but it was just steady as you go. We got solid margins and solid user growth. That was the real question that I had going into Spotify's quarter. It was not only about revenue and margins, the financial results. It was they've been raising their prices. Is that turning customers away? It doesn't appear to be the case today. But let's dig through the numbers. My name is Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. Now, if you're new to Spotify, this is where I always start when looking at a quarterly report. And the reason is all this information is always exactly the same every quarter. You can go back a few years and it'll be the exact same format. That's exactly what we want to see from a company, because it's telling you that they know what the drivers of the business are. In the case of Spotify, first thing that they show is the users. Total monthly active users, this is all users overall, that was up 11% from a year ago to 751 million. So now we're now at 750 million people using Spotify on at least a monthly basis. Second number is premium users. These are going to be the people who are actually driving Spotify's financials, paying that monthly payment. So for us, for our family, it's about $20 a month for Spotify. They just increased that. I'll talk about that a little bit in their pricing power in the market, but that's up 10% to 290 million. But ad-supported users, and this is where a lot of their growth has been over the past few years, this is going to be primarily in less developed countries. So most of the premium users are going to be in Europe or in the US, and then ad-supported is going to be a little bit lower revenue per user, and that's going to be more developed countries. But that was up 12%, so still increasing that market to 476 million subscribers. Then the financials follow that. Premium up 8%, so we're not seeing a lot of price increases, at least in this particular quarter. I think that is something that we are going to see in 2026. Ad-supported revenue, actually not great. This has been my biggest criticism of Spotify. They've actually redone their entire ad stack. So they're thinking that 2026 is going to be a turnaround. I want to see evidence that that's actually the case, but the ad-supported business has just not been all that impressive. Just $518 million worth of revenue in the quarter, and that was actually down slightly from a year ago. But gross profit, this is what's the most impressive for Spotify over the past few years. They've been able to increase their gross profit, something I think a lot of investors thought was going to be capped because they do have to share some of that revenue that they're generating, especially from those premium subscriptions, with content providers, so with artists, and then also now with authors. But this gross margin keeps ticking higher, now 33.1%. Operating income up 47% to $701 million, and that was a phenomenal 15.5% operating margin. The other thing, free cash flow, actually down a little bit from a quarter or from a year ago, but still $834 million in free cash flow is really positive. On all these metrics, they also beat their guidance. So things are going even a little bit better than management has guided for. And like I said, those price increases that we've seen over the past few years doesn't seem like it's affecting their subscriber growth. And that is really the canary in the coal mine. If they start to lose subscribers because other companies are offering a better price or maybe a better subscription bundle, that could be a real problem for Spotify. I want to show a couple of charts here to just put some context in how much of a compounder Spotify has been over the past few years. So this goes back all the way to 2015. So this shows you that Spotify's total revenue has grown at a compound annual rate of 24%. So just phenomenal growth rate. That growth rate is slowing a little bit, but what you're seeing over the past few quarters is they're actually increasing their margins. And then this orange column is their free cash flow. So they're now $2.9 billion in positive free cash flow over the past 12 months. If we look at gross margin and operating margin, so this gross margin is in green, operating margin in blue. You can see why investors didn't think that there was a lot of upside with gross margin. This was at 25 to 26, 27% for a number of years here and didn't tick up until the past few years. A few reasons for that. One is those price increases that I talked about. So that's adding a little bit more revenue. They've also basically started kind of like a pay for placement for artists. So you release a new song, you want to be added to playlists, you want to basically be put in front of users more. That is something that you can actually pay for as an artist or as a record label. That's helping increase their margins. You also have bundling with audiobooks. So that is making this more of a bundled service. And that's going to also help margins because the counterparties, the suppliers of music in particular, aren't going to be able to squeeze out quite as much margin as they could in the past. So those margins have ticked higher. I want to actually just show this on a quarterly basis. because most of this improvement is just over the past couple of years. Let's look at these trends just since the end of 2023. You can see that steadily, especially these operating margins, just going up and to the right. Now, there is going to be a cap to that. They're not going to be able to get to a 40% operating margin, for example, but getting to 15, maybe even 20%, it was something that a lot of investors thought was crazy just a couple of years ago.
Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now.
Spotify also now has a ton of flexibility because they've got almost $10 billion worth of cash. There is a little bit of debt on the balance sheet, but almost $10 billion worth of cash. So they could buy back stock if they wanted to. They could acquire companies if they wanted to. They could continue just growing organically as well. Now, the valuation for the company is not a no-brainer. And this is what I kind of struggle with as a shareholder of Spotify today. Sold about half my stake a couple of months ago, beginning of December. And that turned out to be pretty good timing despite the move today. But it doesn't mean that this isn't just a phenomenal company that's going to continue to compound revenue growth and free cash flow long term. The question is, what are you paying for that growth in free cash flow? So right now, the enterprise value about $80 billion, price to free cash flow right here on a trailing basis is about 25 on a forward basis based on analyst estimates. They don't think that that free cash flow is going to improve next year. So it's still about 28. So that's still a pretty high multiple to be paying for a company that even over the past 3 years has only grown about 15%. And over the next year, are we going to see that growth rate fall down into single digits? The biggest lever that they can pull to continue growing the business, to continue raising those prices. There is a limit to that. They, I think, push that about as far as they can, especially in developed countries. Now, the next thing that they have to do to continue growth is that ad-supported side. Advertising allows you to grow not only those ad-based users, and there's hundreds of millions of those all around the world. It's also going to allow you to grow in things like podcasts and also video. So there's potential there for Spotify to continue growing. I don't think I'm going to be selling my shares anytime soon. But this is also not a stock that I'm buying at this point because I think that valuation is too high, especially for a company that's growing at best in the mid-teens growth rate. A lot of the low-hanging fruit from when I was buying shares in 2023, that fruit has been picked. Spotify can continue to grow, but it's not going to be a rocket ship from here just based on their valuation. But let me know what you think about the results. Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.